ExamPrep.School. Montana Life Insurance Exam, exam code InsMT-Life01 or OPMT-Life01. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Completing the application, underwriting, and delivering the policy. Montana statutes and rules. Common to life, disability, property, and casualty. Montana statutes and rules. Pertinent to life insurance and annuities only. Policy provisions, riders, options, and exclusions. Retirement and other insurance concepts. Types of policies. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which of the following most accurately describes the premium payment pattern of a straight life whole life insurance policy? A. Premiums are level and payable until the insured reaches age 100 or dies, whichever occurs first. B. Premiums are paid over a limited number of years, after which coverage remains in force without further payments. C. A single lump sum premium is paid at policy issue, funding the entire death benefit. D. Premiums vary annually based on changes in the insurer's mortality experience. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is A. The correct answer is that straight life whole life policies require level premiums that remain constant for the insured's lifetime, typically up to age 100 or death. Reason B is not correct. Describes a limited pay policy rather than straight life, whole life. Reason C is not correct. Describes a single premium policy, not straight life with level periodic payments. Reason D is not correct. Describes a variable or adjustable premium feature not found in straight life, whole life. Question 2. Under a 20-pay limited pay whole life policy, premium payments cease when the insured has completed how many years of payments? A. 20 years, after which the policy remains fully in force without further premiums. B. Until the insured reaches age 65, regardless of the number of years paid. C. Immediately upon the death of the insured, regardless of premiums paid. D. When the policy's cash surrender value equals the face amount. The correct answer is A. The correct answer is that in a 20-pay limited pay whole life policy, premiums are paid over 20 years and then no further payments are required while coverage continues. Reason B is not correct. Describes a policy paid to a specific age rather than a fixed number of years. Reason C is not correct. Premiums do not cease upon death. Coverage ends and death benefit is paid. Reason D is not correct. This condition applies to single premium policies, not limited pay whole life. Question 3. Which characteristic is unique to a single premium whole life insurance policy compared to other whole life funding methods? A. Entire required premium is paid at policy inception in a lump sum. B. Premiums remain level and are payable until the insured's death or age 100. C. Premiums are scheduled for a fixed number of years, such as 10 or 20. D. Premium payments can be adjusted annually by the policyholder. The correct answer is A. The correct answer is that single premium whole life policies are funded by one lump sum payment at issue, unlike level pay or limited pay methods. Reason B is not correct. Describes straight life whole life, not single premium funding. Reason C is not correct. Describes a limited pay whole life policy, not a single premium design. Reason D is not correct. Describes a flexible premium policy, not single premium whole life. Question 4. What primary feature differentiates a participating whole life policy from a non-participating whole life policy? A. Eligibility to receive dividends from the insurer's surplus earnings. B. Guarantee of level premiums until the insured attains age 65. C. Requirement to fund the entire policy with one lump sum premium. D. Option to select variable premium payment schedules. The correct answer is A. The correct answer is that participating whole life policies pay dividends to policyholders based on the insurer's surplus, whereas non-participating policies do not. Reason B is not correct. Level premiums until age 65 describe a limited pay design, not participation feature. Reason C is not correct. Describes single premium funding, unrelated to dividend participation. Reason D is not correct. Variable premium options apply to universal life policies, not participation status. Question 5. A 30-year-old applicant is evaluating a traditional whole life policy and asks about how guaranteed cash values grow relative to cumulative premiums in the early policy years. Based on the guaranteed cash value schedule, which statement best describes their relationship during the initial period? A. Guaranteed cash values exceed cumulative premiums paid within the first 5 years. B. Guaranteed cash values are equal to cumulative premiums paid from the first year onward. C. Guaranteed cash values remain lower than cumulative premiums paid in the early years. D. Guaranteed cash values are guaranteed to match the face amount after 10 policy years. The correct answer is C. The correct answer is that guaranteed cash values are lower than cumulative premiums in early years because initial premiums cover acquisition costs and reserve buildup lags. Premium payments. Reason A is not correct. Guaranteed cash values do not exceed cumulative premiums early on because acquisition costs and reserve buildup defer growth. Reason B is not correct. Guaranteed cash values start below premiums and only eventually catch up after several years, not from year one. Reason D is not correct. Guaranteed cash values never automatically match the face amount. They grow gradually and remain below the death benefit. Question 6. After paying level premiums on a whole life policy for 15 years, a policy owner asks how the policy's face amount and cash value relate. Which statement most accurately describes the relationship at that point? A. The face amount remains level and exceeds cash value until policy maturity or paid-up status. B. Cash value will eventually exceed the face amount as the policy approaches maturity. C. Cash value and face amount increase in lockstep at the same guaranteed rate. D. Face amount plus accumulated dividends equals cash value after 20 years. The correct answer is A. The correct answer is that the guaranteed face amount stays level and remains higher than cash value until the policy reaches full maturity or is paid up. Reason B is not correct. Guaranteed cash value does not exceed the face amount in traditional whole life. It remains lower until maturity. Reason C is not correct. Cash value grows while the face amount stays level. They do not increase in lockstep. Reason D is not correct. Accumulated dividends may increase cash value or death benefit, but do not guarantee that face amount plus dividends equals cash value. Question 7. An insurer explains that its whole life policy reserve serves to ensure future benefit payments. In practical terms, which description best captures the high-level concept of a policy reserve? A. The cash value minus any outstanding policy loans. B. The excess of net premium reserve over the policy's cash value. C. The amount the insurer must hold to cover future policy obligations. D. The projected dividend accumulation based on current mortality experience. The correct answer is C. The correct answer is that a policy reserve is the fund the insurer holds to meet future benefit obligations, reflecting the insurer's liability for promised policy benefits. Reason A is not correct. The cash value minus loans defines the surrender value, not the policy reserve. Reason B is not correct. There is no separate excess reserve. The reserve itself is held to cover future obligations, not compared to cash value in that way. Reason D is not correct. Dividends are determined by experience and are not the same as the policy reserve held by the insurer. Question 8. Which of the following best describes the premium pattern for a level term life insurance policy? A. Premium decreases each year as the policy's face amount reduces. B. Premium increases annually based on the insured's attained age. C. Premium remains constant throughout the specified term. D. Premium resets to a new level at the end of each policy year. The correct answer is C. The correct answer is that level term life insurance is structured so that the premium stays the same throughout the policy term, rather than fluctuating with risk factors or policy provisions. Reason A is not correct. Premium does not decrease in level term policies. Decreasing premiums are characteristic of decreasing term policies where the face amount falls. Reason B is not correct. Premium does not increase annually in a level term policy. That pattern reflects an annually renewable term structure. Reason DT is not correct. Premium does not reset annually in level term. That feature aligns with annually renewable term insurance. Question 9. Decreasing term life insurance is most appropriately used to cover which of the following financial obligations? A. Building cash surrender value over time. B. Final burial and funeral expenses. C. Funding long-term care for aging parents. D. A declining mortgage balance over the loan term. The correct answer is D. The correct answer is that decreasing term life insurance aligns the death benefit with a mortgage's outstanding balance, matching the declining obligation over time. Reason A is not correct. Decreasing term does not accumulate cash value. Its purpose is to mirror a declining liability, not build savings. Reason B is not correct. Final expense needs are typically covered by level or whole life policies, not by a benefit that declines over time. Reason C is not correct. Long-term care funding usually relies on specialized care policies or annuities, rather than a decreasing death benefit. Question 10. Which statement accurately characterizes the premium pattern of an annually renewable term life insurance policy? A. Premium remains fixed for the entire policy duration. B. Premium adjusts annually according to the insured's current age and risk class. C. Premium declines gradually as the insured's policy year increases. D. Premium builds cash value with each premium payment. The correct answer is B. The correct answer is that annually renewable term insurance premiums reset each year based on the insured's attained age and risk classification, reflecting current mortality costs. Reason A is not correct. Premiums in this policy do not remain fixed. They change each year to reflect age-based risk. Reason C is not correct. A declining premium pattern is not a feature of annually renewable term. It describes decreasing term products. Reason D is not correct. Annually renewable term policies do not build cash value. They are pure term with annually adjusted rates. Question 11. Which feature distinguishes a return of premium term life insurance policy from a standard level term policy? A. Accumulates cash surrender value over the insured's term. B. Credits annual dividends against future premium payments. C. Refunds all paid premiums at policy maturity if the insured survives the term. D. Allows conversion to permanent coverage without additional underwriting. The correct answer is C. The correct answer is that a return of premium term policy returns all paid premium to the policyholder if the insured survives the term, unlike standard level term which lacks that refund feature. Reason A is not correct. A return of premium term policy does not accumulate cash value. Its value lies solely in the premium refund. Reason B is not correct. Return of premium term policies do not pay dividends. Dividend features are tied to participating policies. Reason D is not correct. Conversion privileges can exist in standard term policies. They are not unique to return of premium features. Question 12. A 45-year-old insured holds a 10-year term life policy that includes a renewable provision. At the end of the 10-year term, which of the following best describes what the renewable provision allows the insured to do? A. Purchase a new term policy at the original premium without evidence of insurability. B. Extend the original term policy for another term at a premium based on attained age without evidence of insurability. C. Convert the term policy to a permanent policy without evidence of insurability. D. Reduce the face amount of the policy for decreased premium payments. The correct answer is B. The renewable provision guarantees that at each policy anniversary, the insured can renew the term contract without providing evidence of insurability, but the premium will be recalculated based on the insured's attained age rather than the original issue age. Reason A is not correct. Original premium rates do not carry over at renewal. The premium is adjusted for attained age. Reason C is not correct. Converting to a permanent policy is a function of a convertible provision, not a renewable provision. Reason D is not correct. Reducing the face amount in exchange for a lower premium is a non-forfeiture option, not a feature of renewability. Question 13. A 40-year-old policyholder has a 20-year level term life contract with a convertible provision. After 7 years, the policyholder decides to obtain permanent life coverage without undergoing a medical exam. Which feature of the convertible provision permits this action? A. Renew the existing term contract for another 20-year term without evidence of insurability. B. Convert the term contract to a whole life policy without evidence of insurability. C. Increase the death benefit under the term contract without submitting updated medical information. D. Add a waiver of premium rider to the term contract without additional underwriting. The correct answer is B. The convertible provision allows the policy owner to exchange the term contract for a permanent policy, such as whole life, without providing evidence of insurability. Preserving the original face amount but recalculating premiums at attained age under the new policy. Reason A is not correct. Renewing for another term without proof of insurability is a feature of a renewable provision, not a convertible one. Reason C is not correct. Increasing the death benefit requires evidence of insurability and is not enabled by a convertible provision. Reason D is not correct. Adding a rider typically requires additional underwriting and is not covered by the convertible provision. Question 14. Which of the following statements about a single premium immediate life annuity is correct? A. Premiums may be paid periodically over the first 2 years. B. The annuitant may defer income payments for at least 5 years. C. An accumulation period of at least 1 year must precede the payout phase. D. Income payments must begin within 1 year from the date of purchase. The correct answer is D. The correct answer is that income payments must begin within 1 year of purchase, which is the defining feature of an immediate annuity. Reason A is not correct. Paying premiums periodically over 2 years describes a flexible premium annuity, not a single premium immediate annuity. Reason B is not correct. Deferred income for at least 5 years describes a deferred annuity, not an immediate one. Reason C is not correct. Accumulation periods apply to deferred annuities. Immediate annuities begin payouts rather than accumulate. Question 15. In the context of a deferred annuity contract, the accumulation period refers to which of the following periods? A. The period during which the cash value guarantee remains in force without growth. B. The payout phase when the insured distributes accumulated funds to the annuitant. C. The time frame between contract issue and the commencement of income payments. D. The interval after annuitization when the death benefit surpasses total premium payments. The correct answer is C. The correct answer is the period from contract issue until the annuitant begins receiving income payments, which defines the accumulation period in a deferred annuity. Reason A is not correct. A cash value guarantee in force without growth is not related to the accumulation definition. Reason B is not correct. The payout phase describes the distribution period, not the accumulation period. Reason D is not correct. The interval after annuitization involving death benefits is part of settlement options, not accumulation. Question 16. How is interest credited on a fixed annuity contract? A. Based on the performance of an underlying stock market index. B. At a rate periodically declared by the insurer, subject to a guaranteed minimum. C. According to gains and losses in a selection of subaccounts. D. At an unchangeable fixed rate set at purchase with no adjustments. The correct answer is B. The correct answer is that fixed annuity interest is credited at a rate declared periodically by the insurer, but cannot fall below the guaranteed minimum rate specified in the contract. Reason A is not correct. Crediting based on a stock index describes an equity-indexed annuity, not a traditional fixed annuity. Reason C is not correct. Gains and losses in subaccounts pertain to variable annuities, not fixed annuities. Reason D is not correct. An unchangeable rate with no adjustments ignores the insurer's ability to reset rates within guaranteed minimums. Question 17. Maria, age 58, holds a variable annuity contract with separate account subaccounts, including equity and bond options, and a guaranteed minimum death benefit. The equity subaccounts lost 20% in value during the past quarter, and Maria is concerned about her investment risk exposure. Which statement accurately describes how the variable annuity's separate account investment risk and the guaranteed minimum death benefit interact? A. The guarantee ensures that the owner's account value never falls below the initial investment, despite subaccount losses. B. The contract owner bears subaccount investment risk, but the guaranteed minimum death benefit assures beneficiaries receive at least the purchase payments. C. The insurer must allocate assets from its general account to reimburse subaccount losses when death benefits exceed account values. D. Subaccount declines immediately eliminate any death benefit guarantees until the owner pays additional fees. The correct answer is B. The contract owner assumes the risk of subaccount performance. The guaranteed minimum death benefit only ensures a floor equal to purchase payments is provided to beneficiaries. Reason A is not correct. The guarantee does not protect account value from declines, it only ensures a minimum death benefit level. Reason C is not correct. General account assets are not used to offset separate account losses. The guarantee operates via benefit floor, not direct reimbursement. Reason D is not correct. Subaccount losses do not nullify death benefit guarantees. No additional fees are required to maintain the minimum death benefit. Question 18. Edward purchases a fixed indexed annuity that credits interest based on the S&P 500 index, subject to a 70% participation rate and an 8% annual cap. If the index increases by 12% in a given year, what interest rate will be credited to Edward's contract? A. 12%, B. 8%, C. 8.4%, D. 7.2%. The correct answer is B. Interest credited equals the lesser of the participation-adjusted index gain. 12% multiplied by 70% equals 8.4%. And the cap 8%, so 8% is credited. Reason A is not correct. The full index gain is not credited because the participation rate and cap limit the credited interest. Reason C is not correct. The participation rate calculation yields 8.4%, but the cap restricts credits to 8%. Reason D is not correct. The 7.2% reflects a misapplied 60% participation rate rather than the stated 70%. Question 19. Linda, age 65, pays a single premium of $150,000 for an immediate annuity that begins monthly payments 1 month after purchase. Which description best explains how the insurer uses Linda's purchase payment to establish her annuity benefit? A. It is invested in a separate account, and future market performance determines monthly payments. B. It is used with actuarial assumptions about interest rates and mortality to calculate and guarantee uniform periodic payments. C. It remains in the insurer's general account and is returned to Linda's estate when payments commence. D. It is credited to a cash value that Linda can access if she surrenders the contract before annuitization. The correct answer is B. The single premium is used along with assumed interest rates and mortality tables to determine guaranteed periodic payment amounts. Reason A is not correct. Immediate annuity funds do not invest in separate accounts. Payments are determined actuarially, not performance-based. Reason C is not correct. The premium is not returned as a lump sum at annuitization. It is converted into a stream of payments. Reason D is not correct. Immediate annuities typically have no cash value or surrender feature once payments begin. Question 20. Which statement correctly distinguishes a primary beneficiary from a contingent beneficiary in a life insurance policy? A. A primary beneficiary receives death proceeds only after a specified waiting period, while a contingent beneficiary receives proceeds immediately upon claim acceptance. B. A primary beneficiary is entitled to interim policy dividends, whereas a contingent beneficiary is not eligible for any dividends. C. A primary beneficiary designation is irrevocable, whereas a contingent beneficiary designation may be changed by the policy owner at any time. D. A primary beneficiary has the first claim to the death benefit, and a contingent beneficiary receives proceeds only if no primary beneficiary survives the insured. The correct answer is D. This option is correct because a primary beneficiary is first in line to receive proceeds, whereas a contingent beneficiary becomes entitled only if no primary beneficiary survives the insured. Reason A is not correct. It incorrectly introduces a waiting period concept that does not distinguish primary from contingent status. Reason B is not correct. It confuses dividend entitlement with beneficiary priority, which is unrelated to beneficiary status. Reason C is not correct. It falsely asserts that all primary designations are irrevocable, and contingent designations are always revocable. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.